So we paid a little over $27,000 for a note that had a remaining balance of $58,500. So we bought it at a steep discount. It was a zero interest rate note. So that's why we had to discount it, to get the returns that we wanted. And it had an investor. It was to an investor. It wasn't somebody that lived in the property.
What if I told you that right now, today, there are real estate assets trading in the public market at a significant discount to what the exact same asset would cost you to buy privately? My guest today not only sees the gap, he built an entire investment strategy around exploiting it. And that is just one of the 6 ways he invests in real estate. This conversation is going to open your mind. Welcome back to the Real Estate Roundtable. I'm Lancelot Lenard with the Sir Lancelot Group, your home for real, unfiltered real estate conversation across Central, East Florida, and beyond. Most investors find one strategy and go deep. My guest today went wide and then found an edge that most people in this business have never even considered. If you've ever wondered what it looks like to build a true multi-vertical real estate portfolio from scratch, this one is for you. Most real estate investors have a lane. They flip houses, or they buy multifamily, or they lend private money. My guest today does not have a lane. He has a highway. Will Harvey is the founder and principal of Harvey Capital, a real estate investment firm where he operates across what I count as 6 distinct verticals: hard money lending, house flipping, hospitality assets, including hotels and wedding venues, passive multifamily investing, seller finance note acquisitions, and something we are going to spend some serious time on today: identifying valuation disconnects between the public and private real estate markets. The last one is not something you hear discussed on most podcasts, and I think it is going to be the most eye-opening part of this conversation. Will has been featured on the Best Ever Real Estate Show with Joe Fearless and the Apartment Building Investing podcast with Michael Blank, so he knows how to deliver real value. Will, welcome to the Real Estate Roundtable.
Hey, Lancelot, thanks so much for having me. That was quite the intro. I hope I live up to that.
I'm sure you will, my friend. I'm sure you will. Will, most investors spend years mastering one strategy. You're running 6 simultaneously. Where does that start? What is the origin of that mindset?
Yeah. So the first thing I should say is some of that stuff I'm not actively focused on right now, like flipping. That's something I've done in the past. And my core focus right now is on the public investing and then the hard money. We also own the wedding venue and the hotel. But yeah, no, I can definitely talk on that. I've sort of gone the path of figuring out what I like, what I don't like. A lot of that is, hey, I'm just going to go out and figure out what, instead of learning about it in a textbook, I'm going to go to the school of hard knocks and just do it and figure it out. That's the attitude that I've taken since I got started with all this about 10 years ago. So to answer your question, I started off after I dropped out of school for the second time. I had double hip surgery and came home from the school I was at playing football. And I went into the mortgage business. And I learned the business for about a year and then got started as a loan officer. And I was just doing, regular residential loans. And that's when I caught the real estate bug. And I ended up buying my first house around that first year I started, and then started making more money once I was out originating loans, and bought a couple more rental properties. And I realized that I hated being a landlord. Had 3 of them and was just tired of dealing with tenant stuff. And that's when I pivoted and started focusing more on investing in multifamily. So I did some syndications, a small general partner, but mostly as a limited partner. After I was done with the mortgage business, when I left that, I started a house flipping company with a partner. And that's what I was doing. I was flipping houses, generating cash. And then I was investing that cash into multifamily syndications. So that was a great, did that for a few years. Then with some partners, bought a wedding venue, a small hotel, and just did a few more projects like that. We still own those today. But all the while, I just realized over time doing all that I really enjoy being on the finance side of things. In 2023, I started a small, we have a little over 2 million in it. We started a small friends and family fund, and I was investing in some multifamily projects as a limited partner. And we had some cash sitting around and didn't have a home for it yet. And an old coworker from when I was in the mortgage business, he called me and he was like, "Hey, I got this guy. He lives in Ghana and all his income is there. He can't qualify for anything, but he has a lot of money and he makes a lot of money. Would you be interested in doing a hard money loan to him so he can buy this rental property?" And, he was buying a house for about 900,000 and he was putting down 75%. So it was pretty much a no-brainer from a risk standpoint. It was 10 minutes from where I lived in a good area in Northern Virginia. And before he even got done asking me if I wanted to do it, I was like, yeah, I'm in. That's a no-brainer. So that's how I got started in hard money. It was that accidental loan, and then we just started doing more, and have scaled it from there, and are trying to scale it further.
Was there a specific deal or experience early on that told you the single strategy approach wasn't going to be enough?
Yeah, good question. I think that it was more so. I just learned that it was like, all right, check that box. Rental properties, don't really like that. Let's cross that off the list. Let's move on. And I just kept moving on until I figured out what I like, which is, things that have to do more with the finance side of things than the operating side of things. So I really enjoy lending, and I really enjoy finding opportunities in the public markets, which I'm sure we'll talk about.
Oh, for sure. That's the most interesting part of today's show. So, walk me through Harvey Capital at a high level. What does the firm actually do, and who are you building it for?
Yeah, so right now there's a few different funds that we manage, and these are smaller. But currently, I'm in the process of raising a 506c fund, which will allow me to talk more openly about the fund and the terms and all that. And that's for hard money lending. So that's my focus now, is really taking what we've done over the past few years in hard money, which is about 30 loans, about $4 million deployed in loans. And now I feel like we have a good proof of concept. We have good systems and good processes in place. And now I want to scale that. I want to grow that. And so that's really what I'm focused on now. But we also manage, like I said, that other fund. The fund is closed that we do the public market investing in, but we manage that fund as well. And, I focus on finding those opportunities.
Nice. Are you primarily managing your own capital, investor capital, or both?
It's both. It's, a big chunk of my own net worth. And then, I have family, I have friends, I have, all kinds of people in there as well.
So, what does a typical week look like operationally when you're running this many moving parts?
Oh man, that's a good question. It's very dynamic. It's especially now I have, I'm working on getting this fund going. And so right now I'm working with an attorney to draft all the legal docs, and I paid the fee to him last week, and that was painful, but it's what you got to do. And so, that's my focus now. And lately over the past few months, I've been very, very interested in AI and just what AI can do in a business like mine. My belief is that service businesses, low tech businesses like real estate, lending, those kinds of service businesses, a pest control company, those kinds of businesses, I think are the ones that adopt AI and really use it in their business to either gain efficiencies or just improve in many different ways. I think the ones that infuse that into their business are really gonna be successful.
Awesome. You've
Yeah.
appeared on Joe Fearless's Best Ever Show and Michael Blank's podcast, two of the biggest platforms in real estate investing. What did those experiences teach you about communicating complex investing concepts to a wide audience?
Oh yeah, that was a while ago. That was pre-COVID, so that was a long time ago. But yeah, no, it was. I think that I was nervous going on those shows, especially back then. I was younger and less experienced. But I think that when you settle down and just explain what you're doing and tell your story, that's really all it is. It just comes down to storytelling, and I think that it comes down to simple terms. Like you can explain what you're doing and explain your deal in a simple manner, that's the way to do it. Simplicity is sexy. Someone I've heard someone say that, and I really try to distill everything down to its simplest form, and I think that's the way to invest.
Was there a question from one of those interviews that made you think differently about your own strategy?
Oh man, I can't remember back that far.
Oh, so much water down the river, yeah?
Exactly.
What do you find most investors get wrong when they first hear about your approach?
I think that some people, will question hard money lending and they'll think it's risky, you guys doing fix and flips and that sort of thing. But if you understand lending and how a first lien deed of trust works in a state like Virginia that's non-judiciary and or is non-judicial, where the foreclosure process is very lender friendly, I think that when someone understands that, they might change their tune a bit.
Got you. Let's go vertical. By vertical, hard money lending. You're the lender in this scenario. What does the business look like, and what made you want to be on that side of the table?
So the well, why I'm on that side of the table is because I've been there, done that, done house flips, managed contractors, and like I was saying earlier, it's just not my thing. We made good money flipping houses. Me and my partner, when I was doing that, we made good money. Definitely not complaining about that, but it just wasn't really. I couldn't see myself doing it long term. Just managing contractors and just all the chaos involved with that. I like the finance side. I like being in an Excel spreadsheet. That's where I really thrive. And so that's why I gravitated more to the hard money side. I can live vicariously through the people that we're lending money to and their interesting projects, but I don't have to be the one dealing with contractors and swinging hammers and all those headaches.
And how do you underwrite a hard money loan? What are the three things you absolutely need to see before you say yes?
The biggest thing is the deal. So, what are they buying it for? What is the ARV? That is the single most important factor for both the lender, the borrower, for everybody in the transaction, unless you're just getting paid as a contractor or something. Everybody that has a stake in the deal, the ARV, the after repair value, nailing that number is the absolute most important thing. And I cannot stress that enough. If you're going to screw up everything else on a deal, just make sure you're conservative on the ARV. So that's the most important. And then for us, the next thing would be the character of the borrower. I put a lot of emphasis on their ability, their experience, their humility. Some guys are newer, and I talked to someone a few weeks ago, and he just had this sort of arrogant attitude about it. And, it's probably not someone that we want to work with, because I think you should recognize, especially if you're newer, that this is tough and it's not, there's going to be twists and turns, and you're going to find stuff out that's wrong with the property that you need to fix. And you just have to be able to bob and weave and roll with the punches. So that was two. I would say the third thing is, so ARV, character of the borrower. Third thing would be, let me think, probably the price that they're paying. I want to lend to guys that are buying deals right. There's the old saying in real estate: you make money when you buy, not when you sell. If you're buying at a good basis, that's gonna that will usually that will usually help in the event that something bad comes up down the road.
And what is the biggest risk in hard money lending that most people underestimate going in?
Probably being over aggressive on the amount of leverage that they give. I think that's true in any kind of lending. If you make too big of a loan, you're not going to know until you go through a default in a foreclosure. Because if we give someone a loan and we give them 150% of their purchase price and they pay us off and everything goes fine, we didn't make a good decision. We just got lucky and had a good outcome. But if you do that loan enough, you're gonna end up in trouble. So, I think that just do the proper amount of leverage is really important.
You've done real house flips, real case studies, real numbers. Walk me through one. Pick a deal that taught you something important. Doesn't have to be your biggest win. What were the acquisition numbers, renovation budget, sales price, and net margin?
Okay, yeah. So I'll give you two. One is really good, and one was not so good. So we'll start with the bad one. So the not so good one happened in early 2022. So we got in touch with someone. They found us on Google Ads. That's how we got most of our deals. So they came across our website from a Google ad. They got in touch with us, and we saw their property, made them an offer. It was a condo in Northern Virginia, and we offered them, I want to say it was around 180,000 for this condo, which at the time was a phenomenal price. We were expecting to make around 70 or 80,000 on this deal, which would have been a killer deal. But what happened was this person, she was from another country. She was from Japan, and her husband had passed away a few months prior to that, and she was going back to Japan to be with family. So she just wanted to sell it. The property needed work. And so she got in touch with us, and she needed time to move out. It wasn't something where we could buy it, immediately close on it, get to work, and get it on the market. That's how we liked to do things. And on that one, we got unlucky. What happened was, and it was a bad decision on our part. We gave her time. We gave her too much time. We went under contract for 3 months before closing on it because she needed a lot of time. And by the time we closed on it, the Fed had jacked up interest rates and the market had completely changed. And we thought we were going to make 70 or 80,000. We made I think we made $400. So
at least you didn't lose.
Yeah, at least we didn't lose, but it was a loss when you factor in our time and energy.
Yeah.
So that was the bad one. That was our worst deal we've ever done. Praise the Lord. We've been very conservative on ARVs, which has led to us not taking a loss. Our best one was very similar, where the seller, they got in touch with us. They inherited the property. So this guy's mother passed away, and he inherited the property, wanted to sell it, but he had a sibling that had been living in the property for 30 years. She had some kind of mental thing going on, and a very nice woman, but they needed to help her find her own place, and it was going to take some time. So on that one, we did the same thing. We went under contract, and we gave them 3 months. And during that 3 months, the market went absolutely screaming up and to the right. And we bought that property for $400,000. And 38 days later, we did a very minimal rehab job because we wanted to get it on the market as soon as possible because the market was just on fire. So by the time we took over, we did a very minimal rehab job, and we ended up selling it. We bought it for $400,000. 38 days later, sold it for $650,000. And our net profit after all expenses was just under $150,000. So it was just an absolute killer home run deal. We made $150,000 in 38 days. It was the best flip we ever did.
That's a good number. That's a good mark.
On both of those, the same thing happened, but in one instance, the market went up. In the other instance, the market went down. And that's just what happens sometimes.
That's the funny thing, because, this is a great story and you have the two perspectives here. And I like to tell my investors and people that are getting into the flipping market right now as new flippers and new investors. And as an agent that been in the business for 11 or 12 years now, you get those phone calls. Hey, would you be, happy to, send me some of your listings that are, rehab ready, and I'd be happy to buy it for cash. And, or can you check out these properties for me and write some offers for me and all that stuff. And I'm like, look, guys, you guys are all looking for the diamond in the rough.
Exactly.
Instead of looking for a doable deal that will make sense. You'll make some money, but you're not going to you're not going to make $150,000 on every single deal. There will be deals where you're going to make a big margin, but most deals you'll make $20,000, $30,000, $40,000. You have to set that number in your mind. What's the number you want to make? And according to that, set your offers and do your work. Because you can't say that you want to make 150 on every single deal, because now you're buying $1 million properties, not $100,000 properties.
Right.
You have to be realistic of the percentage growth that you can achieve in a property. That's then right. You're not buying $150,000, slums. You're buying rehabable luxury properties that you're going to go and put in the $1 million to buy, and then put in the $200,000 to renovate, and then go and sell it for 1.45 or 1.5 and make that margin. Yeah. You're like, I don't want to spend that much money. I get it. But then you don't expect to make 150 on, exactly. On the small deals, because the neighborhoods don't give you that. They don't justify your $150,000 profits. That's the case, and it's just hard to explain. And they don't believe you. And they're like, yeah, sure. You're just not the right fit for us. I'm like, I've been at this for much longer than you have. I'll tell you the truth. That's all I do. But yeah, you get that. You've been in it for long enough to know that's the way it is. It's like, hey, I want to make 40 grand. The house ARV minus, renovations, minus purchase, minus closing costs, minus agent fees. It has to come out at the end for 40 grand. Then I'm happy.
Exactly. And for us, that number was 10% of the ARV. So if we could make 10% of the ARV, so if we're selling it for $500,000, we want to make 50 grand. And if we make 50 grand, we're very happy. If our numbers, if we're conservative and we make more than that, which usually we did because we just tried to be very conservative on the ARVs, then great. We're even happier, And then occasionally you'll have that home run that just comes out of the blue. And but you can't make a business on home runs. It's just not going to happen.
You cannot. It's a good once in a while, hey, Hail Mary, but you're happy. Oh, wow.
Exactly.
This happened. Now we can buy two next time instead of one, because you made the money for it. So the house flipping market has gotten harder in recent years. Margins compressed, competition intensified. And, that's due to all the media outlets out there pushing, possibilities for BRRRR, et cetera, et cetera. So it's just getting more and more compressed, and people are making wild offers on properties that are ridiculous, so they don't understand the actual logistic that goes behind this thing. What does a profitable flip look like in 2026 that didn't exist 5 years ago?
You mean, what do the numbers look like?
Yeah.
Well, for me, I think if you have...
So I figured that you probably know how it looks like.
Yeah. For me, I want a juicy deal. Like we were saying, everything shouldn't be a home run, but you should be selective. And like you were saying, people are paying these batty prices that are just bananas. And, I just don't recommend that. I think be patient, to figure out ways to turn over more rocks and to find more leads, and we were doing Google ads. We were finding sellers that were contacting us directly. None of these people you're never going to get a great deal from someone. If you were to find a truly phenomenal home run type of a deal, you're not going to bring it to some guy you just met that wants you to be their agent. And so if you think that people are just going to bring you these slam dunk deals, you're wrong. And you need to get out there and hustle and figure out how to find them yourself, whether that's sending mailers, Google ads, Facebook ads. There's a ton of different ways that people find success getting to off-market sellers. And for us, it was Google ads, but I think that's the way to do it. And to answer your question, a profitable deal, I still go back to, for me, like when I'm looking at someone's deal, if they're more experienced and they've done this a bunch, then I'm not going to put as much scrutiny on their numbers. I just want to make sure that their ARV is good and all that because they have experience. They can, I trust that they're coming up with good numbers. But for someone that's newer that we haven't worked with, then, I like to see that 10% buffer. That worked for us. I think it's a good number. And I think that especially if their other numbers are a little like their rehab budget, if it's a little bit thin, if I think that they're underestimating their rehab budget, then I really want to see that there's a wide gap between their all-in cost and whatever the ARV is.
Is that viable in today's market? I'm in Florida. In Florida, it's hard, man. It's hard to find those deals. Up where you are or other parts of the country that you service as a lender, are they actually finding those 10% margins still?
Yeah, I think they are. I think a lot of guys are settling, and I don't think that's the right. I don't think you should adjust based on the market. I think that the market sometimes gets irrational and gets overheated, and you should be patient enough to wait through that kind of stuff, or not even wait, but just look other places. Like I was saying, invest more resources in marketing for the off-market sellers, and I think that those margins are possible.
Let's talk a little bit about the next vertical here. Hospitality is one of the more unexpected verticals in your portfolio. Hotels and wedding venues. Most real estate investors never touch this. What drew you in, and what do most people misunderstand about hospitality as an asset class?
Hospitality is very hard.
I was in it 14 years, my friend. I know it's hard.
Yeah, it's less real estate and more. There is physical real estate that we own,
Yeah.
obviously, but it's less real estate and it's more of a business, because you're putting out a product, you're putting out a place for people to stay or a place for people to get married, and you got to have a good product. Whereas when you have a rental property and a lease attached to that, there's a lot less day to day. Of course, you have to get involved when things come up, but there's a lot less oversight than there is in the hospitality world. So I got involved in that because a family friend of mine a few years ago, we got in touch and had a good lunch together, and we just sort of left it. What's
You got
that?
suckered into it. Yeah.
Yeah, exactly. So that's what he did. He had a degree. Him and his wife had a degree in hospitality, and they had done some successful properties. They had a management company where they managed short-term rentals like Airbnbs and things like that, their own properties, and then also third party. And he ends up bringing me this deal. It was a 7-room hotel that was pretty mismanaged. This guy owned it that he owned a brewery or something, and I don't know how he ended up with this property, but he owned it, and it certainly wasn't being managed to its highest and best use. So we saw an opportunity. They listed it at a price that just seemed silly. They had a residential real estate agent who listed it, who completely mispriced it. They priced it based on like it was a residential property and not based on cap rate and income and all that. So we saw the asking price, and he just jumped in and offered full price and was like, "I'll take it." And they accepted. And then right after that, the price was 800,000. And then the price, or right after that, they were like, "Hey, if you guys are going to back out, let us know because we have a bunch of backup offers." We're like, "We're good. We're going to move forward." And it appraised as is at 930. So, we definitely got it at a good price and put a couple 100,000 into it and made it real modern and real cool looking. Yeah, it's called Basecamp 151 if anyone wants to look at it, basecamp151.com. But yeah, so that property was very interesting. And my partner, we actually have a third party manager on that one. We had one for a few years and their costs were too high. So we just switched back in August, and our new manager is phenomenal. Their name is Jetstream. They do a phenomenal job. So, I would say with short-term rentals and, hospitality, like hotels and stuff like that, you got to be very systems oriented, process oriented. It's all about the right systems and all that. So I hope that answers your question.
How does the return profile of a hospitality asset compare to a standard residential rental?
That just depends. It depends on if you're doing well. Hospitality, our busy season is August through October, and we make a killing during those months. But then in the winter, things really slow down. And, those kinds of hospitality projects, they print money when they're going well. But when they're not going well, they eat money and you just have to feed it. And it's really like, you just have to look at everything over a year's time frame. You can't zoom in because it's so cyclical and up and down. But in my opinion, the returns on a hospitality project should be higher than a regular rental property because there's more headache, there's more moving pieces.
More
So
overhead.
yeah, more overhead. So you should demand a higher return, a higher cap rate.
Yeah. Seller finance notes. You're buying them at a discount. Explain the mechanics of that for someone who has never heard of this strategy.
Yeah, it's we're opportunistic and to buy things when it seems like we can get them at a good price. And so a few months ago, I started with that earlier fund. Through that, I started marketing to seller financed note holders and just saying, hey, if you ever thought about selling your note and getting a lump sum of cash, give us a call. And since I started doing that, we bought two. The first one we bought will probably end up being, on an annualized return basis, it will probably end up being the greatest investment I ever made. So we bought it in December, on December 23rd, right before Christmas. We bought this note from someone for around 27,000, a little over that, I believe, when you factor in our costs. So we paid a little over 27,000 for a note that had a remaining balance of 58,500. So we bought it at a steep discount. It was a 0 interest rate note. So that's why we had to discount it, to get the returns that we wanted. And it had an investor. It was to an investor. It wasn't somebody that lived in the property. So it was an investor that was flipping this. I thought that they were flipping this property. It had a balloon payment on it after 4 years. So everything looked probably, when I, weighed everything and looked at the probabilities, I thought that there were more, the likelihood of us doing well on this outweighed us not doing well because we were buying it at such a low price. Our ITV, which is similar to LTV, but it's your investment to value. That's a term in the note buying world. Our investment to value was very low because of the discount that we were buying it for. So, God forbid if we had to foreclose and take the property back, there should be enough meat on the bone. So long story short, we bought it for 27,000 in late December. And I just got an email yesterday or the day before that they just closed and our payoffs in the mail for 58,500. So do the math on that. That's a pretty high annualized
return plus.
Well, it's 100 when you factor in the time duration. It's off the charts.
Oh yeah.
Yeah.
That makes a lot of sense.
Yeah.
How do you secure notes, and what discount to face value are you typically targeting?
Good question. It all depends on, the length of the amortization, the interest rate. If it's a 5% note versus a 10% note, obviously a 10% note is going to be more valuable, all things equal, because, it's a higher yield. It's an art and a science because, you got to look at it from many different angles. It's not just, hey, what's the interest rate? Hey, what's the unpaid principal balance? Hey, what's the yield? It's factoring all that in. You got to look at, what is our investment to value? Do we have a good enough cushion where, if the borrower defaults, that we're going to be in a good collateral position? So that's probably the most important question. And assuming you can get comfortable there, then it's, well, hey, what's the return? Are we, we're going to be tying up this money. There's an opportunity cost there. Should we do that? Or should we wait around for one that we can get a higher return on or and be good stewards of the capital that we manage, be good capital allocators. So, that's the next question. And, if we're looking at a 5% or sometimes you see 4% rates, 3% rates. And it's just crazy what these people a lot of these note holders are not, they don't do this for a living. And
They're not coached properly by their agents
yeah,
with this. Yes.
exactly. And they'll do a well below market rate. And that's a tough sell if you want to
It's supposed to
liquidate
be an
that.
over market rate because you're taking all the responsibility and
Exactly.
risk of that holding that note.
Exactly.
So I always recommend 1% above, at least 1% above market rate for
At
my
least.
client. That's like at least, if you're going to give them a note, you're going to hold a note, it has to be a percent higher.
Yeah. And when they have
That's being generous.
exactly. And when they have such a low interest rate like that, what is their incentive to refinance it? Zero. They're never going to refinance that thing. So you can't count on a refinance getting your money back. So, you just you gotta look at it from it's very much an art. There's science aspects to it, obviously, looking at the yield and the rate and all that stuff, but it really is an art, because especially with these seller finance notes, there's no uniformity. Some of them are 0 rates, some of them are 10% rates, some of them have balloons, some don't, some are 15-year amortization, some are 30. They're just all over the place. So it's hard to give an exact.
There's no cookie cutter.
Yeah, exactly.
With that, yeah. Is this a strategy that a smaller investor would say 50K to deploy could access, or does it require significant capital?
No, I think someone with smaller money is going to have an advantage, because someone with a lot of money, is not going to want to buy a $27,000 note. They're going to just skip over that and say it's too small. We're not going to waste our time on that. So that's where, somebody with a smaller amount of capital can really, can fill in the gaps there. Yeah.
Yeah. Passive multifamily investing. You're in this as an LP, evaluating other operators and syndicators. After doing active deals yourself, what does your due diligence process look like when you're trusting someone else to execute?
Yeah, good question. So I should say that I have a very small number of guys that I would do deals with. And today I'm not focused on this. I have some deals just from the past that are still active, with guys that, some good. And then, one deal I'm in has been struggling. So, this isn't really a core focus of mine now, but I would say that getting an understanding of who the person is that's leading the deal, that is the absolute most important thing, because you're relying on them to get you from start to finish. They're projecting a 5-year time frame, or whatever the deal is, 5, 7, 10 years, where you invest this much and they're going to raise rents over time, rehab units, whatever the plan is. They're going to project all that out, and you got to trust that they're going to do that, because proformas are not worth the paper they're written on. They're very much just, they don't really, like, I'm not a big proforma guy, because I've just learned that no matter what happens, they're going to be wrong. They're either going to be wrong to the bad side, where they've overpromised and underdelivered, or hopefully they're wrong the other way, where they end up doing better than what they projected. So I would just say getting to know the sponsor, the operating partner, the GP, is vitally important.
Gotcha. That's a good advice for everybody listening. Let's talk about the angle that I think is going to be the most eye-opening for this audience. You look for valuation disconnects between public and private real estate markets. Start from zero. What does that actually mean?
Well, I'll tell you how I got into it, which was another completely accidental thing. So a few years ago, I started a small fund with just my family. So there's 3 family members, including myself, in it, and it's not a lot of money. It's about $500,000. So, and my goal with that was to go out and look in the public markets for interesting opportunities, not necessarily real estate related, but just interesting things that that I could find. So I started doing that, and I found a few things. And a few months into that, I stumbled upon this very interesting opportunity. So it was a liquidating trust that owned 130 J.C. Penney properties. So this trust was formed in connection with J.C. Penney's bankruptcy filing in the late 2020. So J.C. Penney filed bankruptcy, and then these two large mall operators bought them out of bankruptcy. So Simon Properties and Brookfield Partners, I believe, were the ones that bought them. And what they did was they took the operating business, the JCPenney operating business, and they separated that from JCPenney's real estate. Believe it or not, JCPenney owned about a fifth of all their stores. So they took all their real estate, they stuck it in this liquidating trust, and then they spun it out onto the, it just trades over the counter, and they gave those shares, they're technically called certificates, but they gave those to the creditors that were involved in the bankruptcy. The creditors don't want that. They just, they want to get what they can. So I'm sure that they were just dumped on this, illiquid over the counter market. And by the time we stumbled on it, it was basically a portfolio of 130 properties with no debt. They had zero debt. And what they were doing was they were liquidating them one by one. So they were taking these properties that were in 30 different states, and they had a real estate brokerage that was going out and marketing them and selling these properties to investors. And as they sold properties, they would take the proceeds, and after all costs were deducted, they would distribute it to the certificate holders. And so every month we got a distribution that was made up of the rental income, which was a 20-year triple net, master lease to the new well-capitalized JCPenney operating business. So we were yielding about 12 to 13% just on that. And then as they liquidated properties, we received the sale proceeds based on our pro rata, amount of shares that we owned. We received proceeds from that. And the long story short is that the implied cap rate that we bought our position for, was about 14% and through the public markets. And then they were turning around and selling those properties at 7% cap rates. So we were essentially doubling our money just because we were buying through the public markets and then just sitting around being patient and waiting for them to sell these properties. And in a year, we're out of that position now, but in a year we made almost 50% on that, and we had a big chunk of our fund in it, and it was a phenomenal deal.
And why do these gaps exist in this first place, and why don't the markets just correct it immediately?
Well, that's a good question, and I thought that they would, and I think that for these smaller market cap, the total market cap on that when we bought in was somewhere around 700 million. And that might sound big, but that is tiny in the eyes of, the broader stock market. So a sub $1 billion market cap is very small. And those ones are the ones that are going to get less coverage than, the much bigger companies that are in the S&P 500 that trade on the major indexes. So, it was just this illiquid thing that was overlooked, and we got into it at a good time, and it just turned out really well. I just think that markets are inefficient.
And what does the research process look like for something like this?
Yeah, that one was very easy. I like simplicity, and that one was easy. I just looked at their filings. I read all their filings. They are publicly traded. So in their case, they reported their filings to the SEC. They have to file quarterly reports called a 10Q. They have to file an annual report called a 10K. And it goes over in detail, their income statement, their balance sheet, and just all the different elements to the company, in this case, the liquidating trust. And we looked through that, I looked through that and just saw, I was able to, I'm no brain surgeon, but I was able to see what the NOI was, what the contractual rent was. And, I had all the pieces of the puzzle in front of me. I read the lease. I saw that lease. And today with AI, you can streamline a lot of this and get AI to summarize things for you. And, I think I was just starting to use AI back then. This is a few years ago, but, I looked at everything, digested it, and really wrapped my head around it and just saw that, this is a mispriced thing and this should not trade this cheap. And, I think you have to have.
Actually, almost like a stockbroker, a good stockbroker that analyzes all the stocks and says they're trading at undervalue, so we need to buy this stock right now, basically. But it's a little bit more complicated than that because you have to go through a lot more different kind of data than that's. They're all accessible to public, but you have to. I'm pretty sure you got to go and see in different websites and find it in different places and stuff like that.
Well, that's why I like real estate, is because, I can see what their NOI is. And if you can get their net operating income, and you understand the assets that they own, you could, someone that's resourceful and hungry and has time on their hands, you can figure out. There are deals where I've gone, they own hundreds of properties, and I go one by one and try to estimate the value of each one to figure out if it's trading at a good discount. And with technology today, with AI, it's you can do that stuff, and that's where I think I have an edge, is because I'm in real estate. I'm not just some Wall Street fund manager. I have real life real estate experience, and I can pretty confidently and conservatively come to valuations that I think are reasonable for what the underlying assets they own are. Now, if you gave me some AI company, or, Google or Tesla, or even something, even like an insurance business or something like that, I don't have an edge there. I don't know what I'm doing there. I don't know how to value something like that. But staying in my lane, and, the whole Warren Buffett circle of competence, that's where I try to be. And, I'm comfortable in real estate.
And what would you tell someone who wants to start learning about this? Where do they begin?
I would look at, there's some websites. There's Value Investors Club. Now, they're going to have all kinds of companies on there, not just real estate companies. So you're going to have to pick through. And, if you're a real estate guy, there are REITs and things like that are posted and talked about on there. So, I would look there. But the biggest thing is just be endlessly curious. And I would just go A to Z through different REITs and different real estate heavy companies, and see if there's, something trading below what their assets are worth. And then, if there's some catalyst there has to be a catalyst to unlock that. In the case of that JC Penney deal, they were actively in a liquidation. So that's a pretty clear cut catalyst. If it's a situation where they own all this, real estate and it's undervalued, but there's a controlling shareholder who's a knucklehead and isn't doing anything with it, then, that's not a good company. But yeah, so I would just be endlessly curious and start reading through different company filings and try to start valuing these companies and what their underlying real estate is worth.
Well, before we wrap up with your big picture philosophy, I wanted to do our Florida deal breakdown, where we get specific with one real deal. You've done flips, you've lent hard money, you've been in hospitality. Pick a single deal from your portfolio, any vertical, that you learned the most from. Not necessarily the biggest win. Walk me through it. What you paid, what you did, what you got out, and what the deal changed about how you invest.
Well, I'll give you a losing deal. Is that okay?
Yeah,
Yeah.
anything.
Okay. It was one that we didn't do well on. Me and two partners. We did this funky deal. It was early 2022. We bought it, and it was one where I didn't really have a clear exit plan with it. It was outside of the typical. We like to be in that box where we're buying for somewhere around 300 to 500,000, selling for, higher than that. And that was where we like to be. So not even 305, I would say 200 to 450. That was our sweet spot. We didn't like going after the luxury, the more expensive stuff, just because it's more risk, it's more time, more bad outcomes can happen when you're doing that. We were all about going after the singles and the doubles, and let's avoid the home runs. So, I strayed from that, and we found this property. Someone got in touch with us from our Google ads, and we ended up buying this property. It was $860,000 that we paid for it, which was well outside. It was the most expensive flip that we had ever bought. Should have never bought it. Should have never, even looked at it, because it was outside of our typical, buy box. And but we didn't, and talked myself into it. We didn't really have a clear exit plan. We were looking at doing Airbnb, but also maybe going to flip it. So it wasn't really, I was just very unfocused on it. And, I think that I let emotion get in the way, and I had what I call deal goggles on, where, it's like beer goggles, but deal goggles, where you see a deal and you just want to, you just want to do it so bad.
No matter what.
Yeah. And you talk yourself into it. And that's what happened. And, I should have, there were a million red flags and a million reasons to walk away from this deal, and I didn't. And long story short, we lost about 70,000 on it. But beyond that, it was the headache and all the just we were running it. It was just such a funky property. We were running it as a short-term rental and had the floors, all separated from each other. And it was so goofy. And it was just kind of doomed to failure from the start. We overpaid, and the market changed, interest rates went up, and it was just terrible timing, for one, which we can't control that. But ultimately, I should have never been involved with something that was that far outside of my typical buy box.
So if you lost everything tomorrow and had to start over with 50,000 and the knowledge you have now, what is the exact sequence of moves you make? Which vertical do you enter first, and why that one? And what mistakes do you absolutely not repeat?
So you said 50,000, and I have all my knowledge.
Yes.
Okay. If I had 50,000 and all my knowledge, I would probably go into flipping, because I think as a house flipper, you can really leverage, and I don't mean financially. I just think that, look at that deal where we made 150 grand in 38 days. That is that is nearly impossible in any other type of industry. But in house flipping, where there are hard money lenders, where if you have a good deal, you can get close to, if not 100% financing. So, I can use my 50,000 to renovate it or to start marketing, and I can generate some deal flow. And then, I can try to buy an absolute killer deal at a really good price, use leverage, use a hard money loan, buy it, fix it up, sell it, hopefully make some more money. And you start snowballing that. So that's probably what I would do.
It's a good one. I like that. I think flipping is one of your bases. If you do that well, you can excel at all the other ones, because all the other ones are more safer. Let's say less risk, less return. Yeah. So, it's probably the riskiest one, but you can excel much faster in it.
Well, it's risky based on the price you're paying. If you're buying something for 50 cents on the dollar, show me the risk there. I don't.
True.
You know what I mean?
But it has a lot of moving parts.
True.
More management, more, the contractor found this, stuff, more unseens, more than, going through the books and, okay, I see everything here.
Yeah,
everything
that's true.
Paper, black and white. You can't really mess that up, unless they're lying to you. That's the only way that gets messed up. But then you pull out before the end because you figured that out. On a house, you buy that house. It's a good deal to go into it. And you're like, did we open up the walls? Do we know what's behind it? Dude, the whole place is eaten by termites. Now we have to change all the wood out. Yeah. Boom. Yeah. That's a Florida thing, by the way. So it happens down here. And then your budget goes from 50,000 reno budget goes to 100,000 reno budget. There goes my profits.
That's very true. But again, if you bought it at a good price,
Exactly. You
you're
bought it if you
hopefully
tried.
going to at least break even.
Break even, and then you can go back at it and find another one.
Exactly.
Last question before rapid fire. What does the real estate opportunity landscape look like right now? And where is Will Harvey putting his focus over the next 12 to 24 months? Is the public private valuation gap currently presenting opportunity in any specific sector?
So I can't speak for other sectors in the public markets because I really only focus
Only
on what I
real
know, which is real
estate.
estate. So in real estate, yes and no. Now, my main focus, I'm still looking for those types of opportunities. I think that the market is in a weird spot, and I a lot of patience is required in that space if you want to buy something truly at a great discount, like that JC Penney deal. So my a lot of my focus now is on hard money lending. I'm currently raising. I have the attorney doing the docs to raise a 506c fund, and that's going to be my focus over the next few years, Lord willing. So I'll certainly still focus on those hard money or those publicly traded opportunities, but that's more of a passive thing. And my more active thing is hard money, just finding good borrowers, good projects to get involved with, and yeah, that's the focus.
And for the investor listening right now who wants to get into the game, what is the smartest first move in the current environment?
I would say start networking with people. I would go to as many RIA meetings as you can. I would just start meeting people. I would start meeting people and I would read every single thing you can read, every book you can read, everything that is valuable. I would lay your eyes on it and just digest it and try to soak up everything you can, because that's how you lay a good foundation. And then when you start, you can learn from other people's mistakes instead of having to do them yourself.
Okay, rapid fire round. Best book that changed how you think about investing, real estate, or otherwise?
So it's not a book, but it's Warren Buffett's annual letters. So he started writing these annual letters when he did his first partnership in the late 50s, and they go all the way up until present day. And they are just packed with investing wisdom.
One real estate vertical every investor should at least understand, even if they never touch it.
Um, Probably residential. Probably
Big,
residential, I would say, because it's what is it, Maslow's hierarchy of needs, where people need a place to live and sleep, and I think that is the most durable of all the asset classes.
biggest lie the real estate investing industry tells beginners.
It's passive. There's nothing
The
passive about it.
There's nothing passive about it. The sector where the public or private valuation gap is most interesting right now. Name it.
Probably the office REITs. There's some office REITs that I wish I knew more about office and had a little bit more conviction, because there are some things that you can find very cheap.
If you get your hands on an office, how would you convert it? It would be pretty cool too, because they're like super cool assets. They're usually in cool locations and everything. It's just, I think it's
Yeah,
pretty cool.
no,
If you
it's true.
if you could only keep one of your six verticals for the next 10 years, which one?
Hard money lending.
What does financial freedom actually mean to you, and are you there yet?
Yeah, I can do what I want and spend time with my family, and we have resources to go out. And my focus is advancing the gospel and using my resources to advance the gospel for Jesus. And so that's a big focus of mine. And I would say that you being financially free allows me to do that. Praise the Lord.
You should get into scouting, my friend.
Scouting.
Yeah, scouting is we're all
What's that?
reverent. That's the last point in our law. Scout is trustworthy, loyal, helpful, friendly, courteous, kind, obedient, cheerful, thrifty, brave, clean, and reverent.
Oh, I love it.
Yeah. You'd probably find a lot of joy if you have young ones. Kids
Yeah,
or
I
kids on
do.
the way. You'd probably find a lot of joy in doing it too. It has to do with a lot of outdoors instead of
Oh,
gaming
I
and
love that. We don't like the screens.
yeah, no screen time. And
Yeah,
they're all like, yeah.
exactly. Yeah, it's
There's
hard,
a
but
study on that, by the way. I know we've way over time, but there's a study on that kids that have screens in front of them from an early age compared to kids that play outside, the kids that play outside have a way more bigger capacity, higher IQ. They are way more, how do you call this, inventive than the kids that sit in front of the screen. And the development is much faster with kids that don't have screens compared to kids that have screens, like their speech, their movement, everything. Like it has to do with everything in your brain, because all those neurons that connect in there, they grow from you experiencing things, and you don't experience anything from looking at a screen.
Exactly.
Like the physical, that's why, all these baby toys with all the touching, different sizes, different textures and stuff like that is really important to have them experience that, because that's connecting neurons, and the experience is that. I also love traveling. You should travel with your kids. I know everybody thinks it's hard. I have 2 kids.
It is hard.
All over the world. It's hard. But guess what? They grow much better, and the experiences they get will make them better people.
Yeah, I love that. Well, I got to tell my wife that because she loves traveling.
Oh, my wife is here. She's written up the next trip already.
Oh, I love it. That's great.
In front of me. She has it right in front of me.
That's so cool.
Well, this is one of those conversations I'm going to be thinking about for a while. What I love about what you do is that it is a reminder that the real estate investing world is enormous. And most of us are only seeing a small corner of it. Hard money lending, flipping, hospitality, passive multifamily, note acquisition, exploiting the gap between public and private markets. That is a full picture of what this industry can offer a disciplined, curious investor. If you want to learn more about Will and Harvey Capital, head to harveycapital.com. Everything is there. You can also follow Will on X at Harvey 1993. All links are in the show notes. And if this episode gave you a new idea, a new question, or just a new way of looking at the market, I'd love to hear from you. Subscribe to Real Estate Roundtable on YouTube, Apple Podcast, or Spotify. Drop us a review and share this with another investor in your circle. That is the best way to help the show grow. I'm Lancelot Lenard. Until the next time, keep building. Thank you for joining us on Sir Lancelot's Real Estate Roundtable, where we've unveiled the mysteries of real estate together. Remember, in this kingdom of possibilities, every dream home is just a discussion away. I can help your real estate dreams come true. Just call me at 786-449-7518. Until our next roundtable, may your ventures be prosperous and your homes be filled with love and joy. Farewell, fellow knights of real estate.